Robinhood disrupted the trading industry by completely eliminating trading fees. Before, if you wanted to invest in the stock market, you had to pay brokers a fee somewhere around $10 per transaction. Obviously, this was a massive change for the industry, and the traditional big players such as Charles Schwab and TD Ameritrade had no choice but to follow suit. Therefore, no fees has become the new normal. And yet, this competition did not stop Robinhood's growth, so there must be something more to it. In this video, we'll explain Robinhood's business model, in which areas they innovated, and especially what actually makes it so valuable. Within the stock market industry, there are obviously many ways for companies to make money, and trading fees was just one of them. For Robinhood, the biggest chunk of their revenue comes from the controversial so-called payment for order flow.
What follows is 80 seconds of technical blah blah until we get to more humanly understandable business model innovation by Robinhood.
So, when you place a market order to buy a certain stock, Robinhood will bundle it with many other orders and send them to a high-frequency trading firm instead of the actual stock exchange. This company will then execute the trade and pay Robinhood a small commission. Now, these high-frequency trading companies make money by taking advantage of price fluctuations in the market. They possess super-duper technology and algorithms that can identify trends and execute transactions in milliseconds and make tiny profits but on huge volumes of transactions. Some famous company names in this area are Citadel and 2 Sigma. To simplify, by buying the order flow from brokers like Robinhood, it feeds their algorithm data about the impact these orders will have on a given stock price and automatically takes advantage of it. However, these firms have also been accused of illegal or controversial practices such as front-running or executing orders in private dark pool exchanges. Citadel has even been fined millions for that. Now, this practice is very complex, and if you want to understand how high-frequency trading firms work, you can either watch videos that explain it or read the book Flash Boys that goes into detail. Some people say that a lot of their activities are too shady and secretive, that they have conflicts of interest and therefore should be banned completely. But others say that they actually play a positive role by providing liquidity to the market and better order execution quality. But in any case, regardless of all the technical jibber-jabber that I just mentioned, this is not exclusive to Robinhood. Traditional brokers such as Charles Schwab also sell their order flow, and this practice is openly disclosed to their clients. Only Fidelity is the one big broker that takes pride in categorically refusing to accept payment for order flow. Some people have tried to shed a negative light on Robinhood because of that, but in reality it's not uncommon, and Robinhood did, in fact, eliminate trading fees that were coming on top of all transactions, regardless of whether they were sold to high-frequency trading firms or not. So the bottom line is that Robinhood did disrupt the trading industry by lowering the costs for investors. In addition to payment for order flow, they also make money by charging a monthly subscription to those who want to do margin trading, meaning take on debt to invest. And they also earn interest on all the extra cash deposits that sit on investors' account before they put them to work. But again, these are standard practices. Now, contrary to many traditional brokers, Robinhood has almost no customer service and no physical locations. This allows them to reduce their costs and helps eliminate those trading fees for customers. If we take all of that into account, the fact that they are an app and that they mainly take advantage of payment for order flow for the revenue, we can combine all of this under process innovation. They found ways on the back end to provide better offers to their customers by reducing their costs and still generate revenue. It's not surprising, given that the founders, Robinhood himself, Vladimir Tenev and Bai Jubat, previously worked in New York's financial institutions, building high-frequency trading platforms. Now, however, as I said in the beginning, this is not anymore the reason that gives Robinhood a valuation of $8 billion in 2020, since other brokers have adapted and embraced the no-fee stock trading. So what does? The answer is, wait for it, millennials. If you're a millennial, smash the like button. And if you're not a millennial, you should smash the like button anyway. Obviously, everyone should do it. This is just the only way I found to plug it into this video. I mean, it's not very creative, but whatever, you get the point. So, Among many other things that millennials are accused of, they are the generation that is the least interested in the stock market investing. But we love apps. If you want to convince a millennial to use something, just give them an app and get their attention inside their natural habitat, which is a mobile screen. Jokes aside, before Robinhood, in order to start investing, you had to open a brokerage account, and the process was not so straightforward. So Robinhood simplified everything thanks to an easy-to-use app with slick user interface. They solved a problem in the market, the problem being that millennials are not participating enough in the stock trading. So many businesses, a huge chunk of the economy actually, depend on the new influx of investment funds in the stock market, and millennials were the natural missing target. They had to get them, and Robinhood made it happen. In part thanks to their app, no minimum deposit required, and of course by eliminating trading fees. One can look at this step as a huge discount from the whole trading industry to attract millennials. Now you know our power. If we collectively ignore something, we can get some cool discounts. But watch out, however. By attracting amateur investors to their platform, well, it's risky by definition. Robinhood actually counts on beginner investors not knowing what they're doing to make money, and it can be very dangerous. Some high-profile cases include a 20-year-old committing suicide because he believed that he was $730,000 in debt. It's a bit of an explosive approach to specifically attract noob investors and offer them a premium gold subscription to invest borrowed money. What could go wrong? Also, by depending on the high-frequency trading companies buying Robinhood order flows, they expose themselves to regulations that might one day forbid or drastically limit this practice. But their 13 million subscriber demographic, with an average age around 30, would definitely remain valuable in any case. Just think about how obsessively Facebook wanted to buy Snapchat. It was mainly to have access to its teenage users who would then stay inside Facebook's ecosystem. For Robinhood, it's the same. They can either do an IPO and start offering more and more traditional banking services to their users, or be acquired by a bigger institution which will then have access to all these customers. If you want to learn strategies and tactics used by the most innovative companies, make sure to check out our bestseller business model innovation course by clicking on the link in the description or right here. Also, do subscribe to my channel and click the bell button to be notified when new videos are up. See you soon!